Hello there and welcome. Peter Hughes here. In this video I'm going to talk about my new book, Where Next for Operational Risk, a guide for risk managers and accountants. Perhaps the best way to summarize what it's about in a few words is a challenge to current thinking. The description on my book's cover adds a little more detail. In his book, Peter examines how the banking sector lost its way in the area of operational risk management and gives his own thoughts on the next generation risk and accounting tools and techniques that will resolve many of the issues banks currently face and optimally position them to meet both the known and unknown challenges that lie ahead. Professor Julian Williams, who is the Executive Director in the Institute of Hazard, Risk and Resilience at the Durham University Business School, very generously wrote in the foreword to my book. We are indeed fortunate to have had Peter on the business school's faculty these past years. Readers of his book will be equally fortunate to benefit from his expert knowledge of the subject matter that he presents in such an engaging and practical way. Most importantly, readers will obtain the tools and techniques to resolve one of the industry's most elusive and longest-standing conundrums: how to quantify and value exposure to non-financial risk. So let's get into my book. It's divided into 4 sections. The first is an introduction. Then I focus on operational risk management. The third section addresses accounting, and the final section is titled Next Generation Advanced Measurement Approach, which is where I go into solution mode. Maybe a good place to start is what motivated me to write the book. I deal with that in the preface. I'm an English chartered accountant. For more than 25 years I held senior positions in finance, audit, operations, risk management and treasury and trading in a top-tier global bank. Since leaving JP Morgan Chase in 2003, I've worked in academia and run my own consulting and training business. My work has taken me all over the world. At the last count, I had worked in more than 50 countries as a banker, consultant and executive trainer. With all that behind me, I'm now sitting down to write this book, having completely lost faith in my profession. The reason? The accounting profession has ignored the biggest, most dramatic change to the banking sector there has ever been. So, what was that dramatic change? I deal with that on page 4. In the latter part of the last century, the digital revolution transformed operating infrastructures beyond all recognition as it spawned globally interconnected electronic banking and trading platforms that, in turn, facilitated the development and delivery of increasingly sophisticated products and services, fueled by the advent of the derivative transaction. New age technologies enabled banks to consolidate their globally distributed technology and operating infrastructures into processing silos that were scaled to support massive growth in production throughput. In my bank, we had 2 massive change programs running in parallel. The first was adapting to the complexification of the global financial system, driven by a surge in investment banking innovation that produced hugely complex derivative, structured and synthetic products and equally complex trading structures. The second was the emergence of new age technologies that enabled the migration and consolidation of multiple, distributed, autonomous, typically country or legal entity-based technology and operations centres into two global technology hubs, one in the USA and the other in the UK. The combined effect was to create massive concentrations of operational risk in two global technology silos. The implications for risk management were considerable, which I describe on page 75. It soon became evident that managing operational risk on such a scale would require substantial new investment. The Operational Risk Management Toolkit began to take shape in the form of key risk indicators, or KRIs, risk and control self-assessments, loss event databases, loss distribution analysis, and process mapping. Maybe because of the rush to design and implement the toolkit, or the lack of engagement with accountants and auditors, the rollout of the new risk management functions and their processes was not entirely successful. Such failure and its causes are a primary focus of this book, but here's a summary. There was an absence of coordination and standardization in the approaches to operational risk management, as business lines were left very much to their own devices when developing their programs. Considerable investment was channeled into the so-called advanced measurement approach, a loss distribution analysis method to estimate exposure to operational risk based on loss history, which could never succeed due to the absence of relevant context information in the form of explicit and dynamic quantification and valid aggregation of accumulating operational risk exposures. Risk and control self-assessment adopted colour coding red, amber or green, or RAG, as its metric for assessing the probable consequences of suboptimal risk controls, thereby disenabling the aggregation and audit of their outputs. So, just to recap, operational risks were managed at the granular operating level through colour-coded key risk indicators and risk and control self-assessments. The regulatory capital requirement, designed to buffer any future operational risk losses, was determined through modelling historic loss distributions to deduce current exposures. Together, they constituted a weak and ineffective approach to operational risk management. Colour-coded risks are non-comparable, non-aggregatable, non-auditable, and not useful for accountants as a basis for risk-adjusting financial statements, not to mention the inherent subjectivity of risk and control self-assessments. On the regulatory capital side, loss history is not a reliable predictor of the future. Indeed, in 2016, the Basel Committee announced the withdrawal of these approaches as an accepted method of determining regulatory capital requirements due to, and I quote, the inherent complexity and the lack of comparability arising from a wide range of internal modelling practices, end quote. The Basel Committee on Banking Supervision's 2013 post-crisis analysis, set out in a paper titled Principles for Effective Risk Data Aggregation and Risk Reporting, included severe criticism directed at banks, as I describe on page 17. And I start by quoting from the Basel Committee's paper. Many banks lacked the ability to aggregate risk exposures and identify concentrations quickly and accurately at the bank group level, across business lines, and between legal entities. Some banks were unable to manage their risks properly because of weak risk data aggregation capabilities and risk reporting practices. This had severe consequences to the banks themselves and to the stability of the financial system as a whole." End quote. So I continue to comment in my book. The Basel Committee's conclusion, however, is focused on symptoms rather than causes. How can it be appropriate to criticise weak risk data aggregation capabilities and risk reporting practices where there is no generally accepted method of quantifying granular op risk exposures? The Basel Committee must have known that the widely adopted method of identifying operational risks and assessing the effectiveness of their management and mitigation is by colour-coding them, red, amber or green. Stating the obvious, you can't aggregate colours. It is the absence of operational risk quantification where regulatory criticism should also have been focused. So, where did it all go wrong? I offer one possibility on page 20. In the original 2003 version of the Sound Practices paper on the management and supervision of operational risk, the Basel Committee wrote, "Reflecting the different nature of operational risk for the purposes of this paper, management of operational risk is taken to mean the identification, assessment, monitoring and control mitigation of risk. This definition contrasts with the one used by the committee in previous risk management papers of the identification, measurement, monitoring and control of risk." So I go on to comment on that. Note the reference to operational risk as being different and the transformation of the word measurement into assessment. The inference is that exposure to operational risk can only be assessed. It can't be measured. This position from the global regulatory standard setter effectively removed the obligation from banks to seek measurement-based methods of managing exposure to this particular risk. Throughout my book, I've included side panels with anecdotes and personal observations, and I couldn't resist including this one, which illustrates the bank's lobbying of regulatory authorities at its worst, because it demanded and got the wrong result. And I'm using fictitious names here. For more than a year, Derek attended the meetings of a banking trade association's advisory panel that was convened to review and comment on the new capital accord, Basel II. He was a regular attendee and had become accustomed to seeing the same cast of characters from all the major banks who also attended the meetings. On one occasion, he received an email from the association's director overseeing the project. He wrote, "Just to let you know, at our next meeting, the regulators want to consult with the industry on an operational risk paper they want to issue." This was coded language that meant that representatives of the National Regulatory Authority wanted to attend the next meeting of the panel. When he arrived at the meeting, Derek walked into a room full of strangers. He quickly identified the regulators. The other strangers were chief risk officers from the big banks. The big guns had been rolled out. Their collective firepower was directed at one word in the paper: measurement. This was lobbying at its most aggressive, with much mid-air finger stabbing as the bankers went on attack. "You don't understand. Operational risk is not like market and credit risk. It's different. You can't measure an operational risk like you can a market or credit risk. That word measurement has to go." I'll leave Derek's true identity to your imagination and whether this side panel describes fact or fiction. So the banking sector built its operational risk management methods and systems for a major risk type on the assumption that it could only be assessed, not measured. This became the universally adopted mindset, as illustrated in an academic paper I refer to in my book on page 37. Consider this statement included in a paper published by the Journal of Banking and Finance in 2014 titled Systemic Risk, Governance and Global Financial Stability, written by an eminent group of academics and practitioners. And this is the statement. A risk is inherently unobservable. Only outcomes are observable. My take on this misguided but understandable characterization of risk is set out in the preface to my book. There is a widely held but wrong-headed view that operational risks are inherently unobservable and only outcomes are observable. Accumulating operational risks are unobservable because nobody has insisted accountants should make them observable. Let me explain. Risk in a financial institution is a financial abstraction in the same way that profit or equity are financial abstractions. Making financial abstractions observable so that businesses can measure financial performance and make informed decisions is what accountants do. For example, cost accountants apply their skills to determine a firm's fully loaded cost of manufacturing a product. They gather cost information from across the enterprise, variable costs, fixed costs, overheads, and determine how each step in a product's manufacturing process consumes those costs. The result is unit cost, the fully loaded cost of manufacturing a product. Unit costs provide vital information on the composition of profit margins that are used to calculate product profitability and manage enterprise costs and operating efficiency. In this book, I argue that precisely the same accounting techniques that make the fully loaded manufacturing costs of a product observable can be adapted to make all forms of risk observable. Let's now turn to accounting. On page 7, I set out the accounting arguments in relation to operational risks. It is an undeniable certainty that a business will create and accept exposure to operational risk to increase shareholders' equity. It follows that if a business accepts an operational risk, it also accepts a probability of loss relative to that risk, which can either be expected or unexpected. An expected loss is where a business accepts exposures to risk that are identified, quantified and aggregated, and the aggregated amount is within pre-approved operating limits. The aggregate of accepted exposures to risk is then valued according to the quantitatively modelled probability and severity of future losses that aggregated exposures to risk are likely to produce. Sound accounting practice is to charge that amount to the income or P&L statement in the form of a provision for expected loss, which can also be termed the cost of risk, thereby reducing shareholders' equity. In accounting, the charge to the income or P&L statement is made to the business line that originated the risk so that it can reflect the cost of risk in its product pricing. This is how accounting ensures accountability for incurred costs, including the cost of accepted risks, which also acts as an incentive for more effective risk management and mitigation. In other words, risk management becomes both a risk mitigation and a profit improvement initiative. Accounting for expected loss in this way is consistent with the fundamental accounting principle referred to as the accrual concept, which requires revenue or expense to be recorded when a transaction occurs rather than when payment is received or made. Consequently, accounting for the expected losses associated with the exposures to operational risks triggered by accepted transactions is sound accounting practice that ensures such probable losses are immediately recognized in accounting systems. However, such accounting treatment presupposes exposures to risk can be quantified and valued explicitly and dynamically with reasonable precision. Many will think that cannot be done. It is not possible to quantify an exposure to operational risk. The aim of this book is to demonstrate that it is indeed possible, and it may not be as difficult as people think. So, let's now go into solution mode. Perhaps the result of a 25-year corporate career in relatively senior roles at one of the world's largest banks, it's in my DNA that the escalation of an issue must be accompanied by a plan of action. A plan of action to address the non-aggregatable and non-comparable operational risk management outputs is the implementation of a next-generation accounting method and system we call risk accounting. The two fundamental principles of risk accounting are set out on page 29. The integrated operational risk management and accounting solution described in section 4, a next-generation advanced measurement approach, uses a novel method to quantify and account for exposure to operational risk. There are two fundamental principles. The first is that the quantification of non-financial risks requires a non-financial metric. This is a new area of endeavour, and such a metric did not exist, so one was created and called a risk unit or RU. The RU is a standardized additive metric that is designed to express all forms of operational risk. The second is that exposure to operational risk is created upon the transfer of products and services to, or the execution of trades with, third-party customers, counterparties or intermediaries, as this is what sets operating infrastructures and supply chains in motion. Reporting created in risk accounting revolves around three core metrics, which I define on page 173. The next generation advanced measurement approach introduces a new metric, the risk unit or RU, into the framework. The RU is a common additive metric that expresses all forms of operational risk and is used to quantify, aggregate and report exposures to operational risk using three core metrics. The first is inherent risk RUs, which is the amount of operational risk in RUs before considering the effects of internal risk mitigation activities and processes, and represents maximum exposure to operational risk. Second is the Risk Mitigation Index, or RMI, which is a measure of the effectiveness of internal operational risk mitigating activities and processes on a scale of 0 to 100. And third are residual risk RUs, which is the amount of operational risk in RUs that remains after reducing inherent risk by the Risk Mitigation Index and represents actual exposure to operational risk. On page 181, I observe under the heading Key Attributes of the Risk Quantification Method the following. The Risk Mitigation Index, or RMI, is a composite measure of risk culture as it blends qualitative and quantitative risk attributes from across the enterprise into a single metric. Accordingly, risk governance is focused on planning and implementing strategies aimed at continually improving the risk mitigation index. On page 182, I discuss in a longer-term view how a monetary value of an RU can be derived. A longer-term aim is to calculate and publish the monetary value of an RU by modelling operational risk loss data, statistically correlated with additional context information in the form of residual RUs. Once determined, the monetarily valued RU can be used to estimate operational risk-related expected losses. Expected losses calculated in this way can be used to risk-adjust audited financial statements. This creates the possibility to lobby regulators to adopt the RU in the determination of regulatory capital requirements for operational risks, providing a more effective balancing of risk sensitivity, simplicity, and comparability in capital adequacy calculations. Section 4 of my book includes a detailed walkthrough of the 9 steps that comprise the risk accounting method, written in the form of a self-study guide with fully populated tables, templates, and reports. By working through the 9 steps, you will see all the inputs and be able to rework all the calculations and aggregations relative to 11 sample products of varying complexity taken from both the banking and trading books. My book also reflects on how the various aspects of operational risk management will be impacted through the implementation of risk accounting and the adoption of the RU. They include environmental, social and governance or ESG risks, climate change, models in bank regulation, artificial intelligence and machine learning, infrastructural transformation, operational resilience, 3 lines of defence and the role of audit, risk data aggregation and the portfolio view, risk culture, systemic risk and expected losses, risk capital, value at risk or VAR and accounting, risk adjusting accounting, accounting measures for operational risk, fintech and the new challenge for accountants, risk accounting and economic profit. My book is available at Amazon and other reputable booksellers all over the world at a recommended retail price of £25 or its equivalent in other currencies, although some booksellers are offering some pretty nice discounts. Many thanks for watching this video, and I hope you'll enjoy reading my book. Thank you.